The following program was provided by an independent producer solely responsible for its content. The opinions expressed do not necessarily represent the views of this station, its staff, board of directors, or underwriters.
Saving and investing can be confusing and overwhelming. We're here to break through the noise, misinformation, and confusion with easy-to-understand concepts and tools that you can put into practice right away. Whether you're a novice investor or an old pro, join Jason as he explores different topics on investing and personal finance. From 401ks to better budgeting decisions, we'll cover it all. Our investment guidance will give you the comfort and security of knowing that you're on track to achieve your goals. It's time to rise above all of the distractions of daily life and take control of your financial future. Welcome to Financially Fit with your host, Jason Haviland.
Hello, and welcome to another episode of Financially Fit with Jason Haviland. I'm your host, Jason Haviland. Today, we're talking taxes. Not everybody's favorite topic, but a topic that everybody should have some understanding, education, and insights on. So let's jump right in. Today, I'm very pleased to be joined by Robin Tylim. Hello, welcome.
Hi, thanks for having me, Jason.
It's great to have you here. So Robin is the owner of Tax Prep and Financial Services by Robin. You are also a CPA, so congratulations on that and welcome to the show. So today we're going to get into taxes, right? Yep. And maybe a little bookkeeping and some things that small business owners might need to be aware of as they think about all the other things that go into managing and running their business besides taxes, right? So before we jump into that, why don't you tell us a little bit about your background and sort of your business and sort of what the kind of services that you handle?
So Jason, I have over 20 years experience in the financial service industry. Way back when I got my CPA right out of college from New York. I'm actually from New York.
That's okay. We're in New England here, but we still like New York, because that's okay.
Don't worry, I've changed all my teams over. I'm a Patriots fan.
That's good.
So I moved up from New York to work at Fidelity for a year, and then after that, a couple of years ago, about 2 years ago, I decided to start my own little tax preparation business.
Nice.
It took a lot of work to reactivate my CPA license from New York, but it's definitely been worth it, and this will be my second season.
Okay.
And I'm excited to talk about taxes today and make it as fun and enjoyable as possible.
Right. That's not something that people usually associate. Taxes, fun, and enjoyable, and there aren't that many people that are excited to talk about it. So I am excited to talk about taxes with you. All right. So we are now here, we're in the sort of winter time, fall time of 2018, right? So depending on when folks are seeing this, they may or may not, information about taxes changes quite frequently, right? So we should tell everybody that depending on when you're seeing this, some of the information we're discussing today may change.
Yep.
But for people that are filing in 2019 for taxes for 2018, the big thing that's going to impact their taxes this year is the Tax Cut and Jobs Act.
Yep.
All right, so that changed a lot of the tax laws, and a lot of the things that were familiar to people in years 2017 and prior might not be so familiar, or might be actually pretty different for this year.
Yeah.
So why don't you tell us a little bit about some of the changes from the Tax Cut and Jobs Act and what those big impacts might be?
Yeah, so I've been spending a lot of my free time recently reading up on the Tax Cuts and Jobs Act, so I would be prepared to talk to all of you today. The first thing many of you may have noticed is back in the beginning of 2018, you may have seen a jump in your paycheck. That's because the federal withholding taxes were recalculated, so your paycheck might have been higher. And if you lived in a state that also adopted the Tax Cuts and Jobs Act, your paycheck might have jumped even higher, which is a good thing. You have more money to spend.
So that would be like the little deductions that you see. Here's my gross, and then minus, 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 right? One of those minuses got reduced, so your paycheck was a little bit higher.
Exactly.
All right, now, was that a temporary thing, or will I have to pay that back sort of later in the year?
Well, when you get to actually calculating your taxes at the end of the year, you have to take into account all of the changes that the Tax Act has on your income. So it's not easy to just say whether or not it's going to stay a deduction or not, because there's been so many other changes.
Okay.
in the rules, and we'll talk a little bit more about those changes to deductions. And
All
I'll
right, so they changed the withholding amount under your
Yep.
check, so that's going to impact some downstream things.
Yep.
What else is sort of new, different, or
So
sort of interesting to people's taxes as it relates to the Jobs Act?
So it's definitely moving away from a redistribution of income towards a more fair and simplified approach to taxation.
Okay.
So this
That
is
sounds
good for
Tell
this
us
is
about
good for
that.
the everyday person.
Okay.
They're going to be in a better situation. Also, we've seen a decrease in corporate tax rates,
Okay.
which is really good because now corporations will have more incentive to declare dividends from their accumulated earnings. So we're just seeing more money coming into the economy,
Yep.
more people having jobs, more money to spend, all good things.
Okay. So I heard there's some changes with the personal exemption and the standard deduction.
Oh yeah.
So
Yep.
let's recap for folks, maybe what was the personal exemption,
Yep.
what is the standard deduction, and how has that changed?
So in years past, you would receive a standard deduction and a personal exemption. What's happened now is the personal exemption has been eliminated, but the standard deductions have almost been doubled. So they went from $12,700 to $24,000 for married filing jointly, from $9,350 to $18,000 if you're head of household, and $6,350 to $12,000 if you're single or married filing separately. So people are going to have to be really creative if they still want to itemize their deductions.
So that's a big bump in the standard deduction.
Right.
All right. Now, what happened to the personal exemption?
It's just gone.
That's gone. Poof.
Yeah,
All right,
it's
so they
gone.
took that one away, right?
Yep.
So as I understood it, they were trying to figure out ways to, this wonderful new word, revenue neutral.
Right.
Right. So they're trying to figure out if they're going to give people more money in some ways, they got to take some away, right? So personal exemption goes away,
Yep.
but standard deduction, it sounds like in some cases doubled.
Yep.
So
that could
much
be a
larger.
good thing. Yeah.
All right, but now let's dig a little bit deeper into that.
Yep.
The downside to that could be that individuals who were itemizing their deductions,
Yep.
so taking the deductions for things like the interest on their mortgage or
Yep.
charitable deductions,
Yep.
those added up may be less
Right.
than the standard deduction. So
Right.
say a little bit more about that
So,
and the impact of that.
Okay, so there's 6 major changes that I'd like to talk about in the
Okay.
deductions. The kitty tax, for example.
Ooh, kitty as in like kids?
Yeah,
Not
so-
like kitty?
Yes, so children under 19 and children under 24 that are in college, the taxes on their unearned income is now going to be taxed at the trust and estate level.
Okay.
Alimony.
Which is what? Do you know
That's a
approximately what-
sliding scale based on income.
Okay.
I don't have those exact
Okay.
figures. Alimony is another big one. So alimony is no longer going to be deductible. So that's
Okay.
going to come into play when people go and try to negotiate their divorces. This is going to have a big impact.
Okay.
Medical expenses, you used to be able to deduct medical expenses if they were 7.5% of your adjusted gross income. Now in 2019, that's going to be bumped up to 10%
All right, so a higher threshold to
A
be
higher
able to
threshold.
deduct your medical expenses.
on the Schedule A. Yep.
All right, so that's itemizing. But again, if people are now sort of being pushed or are more likely to be taking the standard deduction, that's less of an
Less
issue.
of an issue.
But it just makes it harder if that was a situation you were in.
Yep.
That threshold is
Yeah.
increasing. All right, so medical is increasing.
Yep, and mortgages, like you said earlier, interest on mortgages in excess of $750,000, you cannot deduct that interest any longer.
Okay, so that would be like larger houses or houses in more affluent areas
Yes.
of Massachusetts
yes,
or
yes.
New Hampshire.
And
so
some-
750 is the. So if your house is 800, can you deduct any, or is it just the difference?
Just you're limited to the 750,000.
Up to 750,000 of
the
of the
interest.
value of the interest.
Yes.
You can still deduct that.
Yep.
But again, you're going to be faced with is that reduction. So they reduce the medical, they reduce the interest.
Yep.
Again, not only might it be harder to meet the standard deduction limit, but now it's so much more for the standard.
Right.
Or for the itemized.
Yeah,
harder
it's going
to
to
get
be
the
harder.
itemized
But I do
list.
have a trick that I'll be talking about
Oh,
in a
I
minute.
like that. Tips and tricks. All right,
I
so
have
let's keep going through the list. All right, so we had medical,
Yep.
we had interest, kitty tax, alimony, I think you had two more.
Yep. So state and local
State and
income
local
tax.
taxes, yep.
That's going to be capped at $10,000 for state and local income taxes, as well as real estate and property taxes.
Okay.
So that's going to be really hit hard in the states that have high income tax rates, like New Yorkers.
Right.
They're really going to see that.
So that's just a flat 10,000. Anything above that you can't deduct. So if it's over 10, you just got to stop at 10.
Yep.
If it's under 10, you could still
Yes.
potentially take
Yes.
it. Okay.
And then the last one, which is another biggie, is the non-reimbursed employee expenses.
Right.
That is going away completely from miscellaneous deductions.
All right. That was like 1% of your, if it was over 1%, something like that in the prior years, I believe.
I think that's correct.
Okay. So that's going away.
That's going away completely. So
Okay.
that's going to be a big hit. So my little creative tip that I have for people
Yeah.
is you want to get your itemized deductions to be in excess of these standard deductions to get the most bang for your buck.
Right.
And one way you could do that is charitable contributions.
Okay.
So there are some people that give charitable contributions every single year, same
Right.
amount, but they're consistent. If you were to double up your charitable contributions in one year and skip the next year, that would help you get over your standard deduction limit. And one way you can do it is through a donor advised fund.
That's a great choice.
Which is-
we have a lot of clients that use the donor advised fund strategy. So
And-
yeah, that's
and
a great strategy.
What's great about that is that you can make the investment in you can make the investment in the fund and take advantage of the tax savings, but you can wait to direct where you want, which charity you want the funds to go to.
Right. And with your strategy of doubling up from one year to the next, you may also find the situation where in one year you take the standard deduction.
Yep.
Maybe the next year you go back to itemized standard. You
Yep,
can sort of
yep.
float between the two strategies,
Right.
sort of figuring out which one is most advantageous.
Yes.
Now, is there any impact or limit on the charitable deductions, or are those you're still able to deduct the full amount for those?
As in all my reading, I did not see any limits on charitable deductions.
Okay. So back to full on giving to charity.
Giving to charity.
That's an excellent.
It is the
excellent
season.
Tis the season. Excellent endeavor. Okay. Anything else on? How about the rates themselves?
Yes, I do have that information. If you will allow me to just flip to my cards.
Yes,
here.
Nice
Nice
we
and
like
fluorescent orange. This was a lot to
Well,
memorize.
yes, it was.
So-
No, it's great to have it all. Right? Usually, you got to buy that thick book of, tax knowledge, or go online and download those crazy forms from the IRS. You've got it all on 12 note cards. That's great. All right. So did the rates go down? Did they stay the same?
The rates did go down,
Okay.
and I have the for the different income levels. So from 0 to 9,525, they remain the same at 10%.
Okay.
From 9,525 to 38,700, they went down from 15% to 12%. So that's
Okay,
a good thing.
That's good. Yep.
From the next bracket, 38,700 to 82,500, they went down from 25% to 22%. From 82,500 to 157,500, they went from 28% to 24%. That's
All right,
a
so
nice drop.
that's a little drop there, yeah.
4%. From 157,500 to 200,000, they went down just from 33% to 32%.
All right. So less of a break
less
as
of a
the
break.
higher up you went. Okay.
And then from 200,000 to $500,000, they went from, they stayed the same actually at 35%.
Okay.
And then for over $500,000, they dropped from 39.6% to 37%.
Okay.
So we do see some winners out there.
All right. So that's good. So potentially higher standard deduction,
Yep.
offset by the lower or elimination of the personal exemptions.
Yep.
And then depending on if you were itemizing before or taking the standard, that may
Right.
or may not impact it. The rate gone down. It sounds like, in general, most people should experience a little bit of a tax cut.
Yes.
Who's going to be who would you say are the biggest beneficiaries?
So I have some examples of some winners of a family earning $95,000 that has 2 children under 17 with itemized deductions just over the $12,700. Now, why would this family be a winner? Well, they have 2 children under 17,
Yep.
and now the child tax credit has doubled from $1,000 to $2,000.
Oh, wow, that's a
Yeah.
doubling of of the kids.
And the other
credit.
thing about that is the child tax credit used to be phased out. Now the adjusted gross income of $400,000 is the limit where the child tax credit starts getting phased out. So they've raised that limit so that many more people can take advantage of that doubling of the child tax credit.
Okay, so families with more kids.
Yep.
Will benefit a little bit more.
Yep.
And it sounds like as you went through those tax brackets, it sounds like everybody was generally seeing a little bit of a lowering.
Yep.
But if you were in those lower, in the very lowest and the very highest, not as much change. But in those
Right,
middle
middle
brackets,
ones.
there was a little bit more movement and lowering of the rates.
Yep.
Okay. I think there were some other changes in this tax law as it relates to employees and their approach to employment contracts. Let's talk a little bit about that. What's new in that area?
As I said earlier, they took away the miscellaneous deduction for non-reimbursed expenses. That's going to be a huge hit to employees that have non-reimbursed expenses because now they can't write them off on their taxes.
So these would be things that you paid out of your own pocket in the, working for an employer, some expense that you paid. Maybe you bought supplies or you bought office chairs or equipment or something like that and didn't get reimbursed for it. That's what we're talking about
Or
here.
travel
Expenses. Okay,
Yeah,
so those, if the employer said, go do this thing on behalf of the business, but I'm not reimbursing you for it, those expenses had some deductibility in the past, and now,
unless you're a teacher.
You
still get the $250.
So what's the? I remember them. There's a big hubbub about the teachers. So they carved something else special for teachers.
The teachers still can get their $250 deduction.
That's good. I support that. That's good.
We support the teachers.
Yes.
So sorry. Going back to what we were saying about the
employees
employee.
and employment contracts.
So I wanted to add to that. So one thing that the employee could do is he or she could go to their employer and ask for a stipend going forward in exchange for a salary cut. So therefore, the employee would be remaining in the same financial position as before, and then he or she can just give a full accounting to the employer, and then the employer could write the expenses off. Now that may be troublesome for the employer because they might have to invest in the accounting system to handle all that, but I think that would go a long way to keeping the employees happy. And that's one option. There's another option which is a little more tricky, and that's the conversion from employee to contractor.
That's sometimes, is that, when you say that, is that you're referring to the 1099
Yes,
person? We
yes.
sort of use that word.
Yes.
A lot of people just use that interchangeably as
Yes.
either working on a W-2 as a
Or
salary
1099.
employee or a 1099. So you're referring to that kind
Yes,
of
and
contract.
it's not as simple as just deciding one day you're going to go from an employee to a contractor, because you don't want to get yourself in trouble with the Department of Labor.
For sure.
You have
and nobody,
to.
the employer or the employee, bad all around.
Yeah, you really have to make sure that you follow the letter of the law as to what qualifies for a contractor. I think most of it is surrounding control over the duties. So if the employee is willing to give up some of their control over this employee, that would go a long way towards meeting the requirements of a contractor.
Right, and then the contractor could then claim those expenses as business expenses, write them off against the
1099 income.
1099 income. Then there's a whole nother set of rules around having to pay their own Social Security tax and all those other issues, but that is one option, assuming it's still within the guidelines set by the various regulatory agencies.
Yes.
Let's make sure we add that. Okay. How about moving expenses?
Moving expenses.
Is that still in or is that out?
Another negative.
That's an out. All right, that's another outie.
Unfortunately, moving expenses will no longer be deductible. And if your company pays for your moving expenses, which for me, when I got moved up here from New York to New Hampshire, my company paid quite a chunk of change.
Right.
And I was happy not to pay taxes on that income.
Right.
Now, if you are reimbursed for moving expenses, you will have to pay taxes on that as income, unless you're a member of the armed forces and you're moving permanently until 12/31/2025.
Okay. Wow, that sounds complicated. But the bottom line there is, all right, if you're moving for your job, which in this day and age is pretty common, people sort of move all over the country. if your employer is going to kick in to help for that, you just have to be aware you are going to be taxed on as if they had just paid you that as a bonus or a sign-on or anything like that. You're going to have to pay whatever your income tax is. They're just going to add that to your total, and you got to pay tax on it, so you've got to be aware of that.
Yes, yes.
And do you know if that's subject to the same withholding requirements when they pay it to you? Or like if I agree to give you a $5,000 moving bonus, do I give you all $5,000, or do I have to give you
I'm not sure if they hold,
$200 to withhold from
I'm
that
not sure
to
if
cover that?
they take the withholding right away, or you just have to.
Well, somebody
remember
will have to. You gotta square up eventually, right?
Yep.
You got to pay one way or the other. All right. How about tuition expenses? Any changes there for the?
So the good news on that is tuition for graduates and children of university employees, that will not be taxed. So that's a good thing.
Okay.
Also, the American Opportunity Credit and the Lifetime Learning Credit has been untouched. So that's still a great option for people. And then, what was I going to say?
Well, they're expensive. And no matter whether or not the taxes are deductible or not, what tuition credits you get, sending your kids to college is expensive and difficult, and people paying their own way for college is also very expensive and difficult. So anything, even if there's some credits available there, that's a good thing.
The other good news, sorry, I lost my place in my fluorescent cards, is the 529s.
Yeah.
So $10,000 of the 529s can now be deducted to pay for public, private, or religious school, which is a good thing. And then you can also take your 529 now and roll it into an ABLE account for the same beneficiary or a beneficiary in the same family.
All right.
So those are some good news.
Let's we used a little lingo there. Let's just explain that real quick. So 529 account.
Yep.
All right, that stands for an account that you're able to establish for yourself, a child, a grandchild.
Yep.
You're able to put money in.
Yep.
And it's taxed when you put it in, but then it grows tax-free.
Yep.
Comes out tax-free if you use it for college expenses.
Right.
Now you're saying they're expanding that a little bit to allow for high school expenses,
yes.
as well as the ABLE. Say a little bit more about that.
So the ABLE is a fund that's really to improve the quality of life of someone who's disabled, to pay for services for that person.
Okay.
So
so you're able to, in the same structure as saving for college, or now saving for high school, you can save save and grow expenses tax-free and have them come out tax-free if they're paid for expenses to support someone with a disability.
Yes.
Okay, that's another excellent change. All right, anything around sort of payment of estimated taxes, any taxes you've already paid, or anything else around the general movement of and payment of taxes that are sort of new or unique for this in this bill?
Nothing surrounding estimated tax payments. You're still going to have to make those payments throughout the year. You don't want to wait until the end of the year to find out you have a huge tax bill and that you haven't been making payments along the way.
Okay.
So estimated taxes are definitely something you should be seeking guidance from your your tax accountant.
Okay, like you.
Like me.
All right. How about on the investment side and investment income? Any new or changes there?
Yes, on the investment income, net operating losses can no longer be carried back, but they can be carried forward indefinitely.
Okay.
Also, the Roth IRA recharacterizations made after January 1st, 2018 cannot be reversed.
All right, let's stop on there real quick. So Roth recharacterization, that sounds like a mouthful, right? So just a little bit of context. When we talk about IRAs, there's two basic kinds.
Yep.
There's a traditional IRA, which is pre-tax money going in, grows tax-free.
Yep.
You pay tax on the way out.
Yep.
And then there's a Roth, which you pay tax on now.
Yep.
It grows tax-free, and then tax-free on the way out.
Yep.
Right, so one's tax-free on the way out, one's taxable on the way out, one's tax-free on the way in, one's taxable on the way in. Now, when you say recharacterize, that means, reclassifying money that you had thought you wanted in one bucket into a Roth sort of flipping it back and forth.
You used to be
can't do that anymore.
you used to be able to go from Roth back to traditional, back to Roth.
Right.
Now, once you've made that decision to be a contribution to the Roth IRA, you cannot convert it back to a traditional.
Okay, so that's one and done.
Yep.
All right. Anything else on the investment side?
Well, just that I'd like to reiterate that corporate tax rates have went from a blended 35% to a simple 21%.
Okay,
So
that's a big
gonna,
change.
Yeah, that's going to impact investment managers' strategies.
All right, so corporate tax rates coming down. There's also changes to pass-through entities.
Yes.
Like sole proprietors, partnerships, S corporations. So now which is better, to get the break from the pass-through entity or being a corporation?
Well, they enacted the 199A deduction, which is a 20% deduction for small business owners.
Yeah.
This was enacted to try to equalize the cut in the tax rates to the corporate taxpayers so that the pass-through entities would have the same advantages.
Okay.
However, in order for them to take those advantages, they must meet the thresholds and phase-outs, which are $315,000 for married filing jointly.
So that's
or-
$315,000 for your small, if you have a small
Yes.
business.
Yep.
The revenue or
the revenue.
the revenue at
Yep.
315 or the profit at 315?
I'm not sure.
Okay, so a high number
Yep.
that you'll have to check, but it phases out above that.
Yes.
Okay, but you get what if you are below it?
You get 20% of a deduction
Okay.
on your Schedule C.
Okay, so you get basically 20% deduction to the extent you're below that.
Yep.
Or you could flip to a C corporation and enjoy the corporate tax rate,
Yep,
which is
yep.
now, you said, 21%?
Yep.
Okay, so that's something you're probably going to have to sit down and do some fairly intricate planning around to decide
Yes.
what's better for you.
Yes.
Okay.
You'll definitely want to meet with your accountant to discuss this.
Okay. All right. Anything else from the tax changes that we haven't talked about that you think might be worthy of
Just
mention?
in summary, I guess I would just like to say that it's important that you pay attention to any way that you can itemize your deductions, take advantage of the 20% deduction that may be available to you, and meet with your accountant to make sure your taxes are going to be right this year with all the new changes.
That's right. It sounds like there's a lot to be paying attention to and to sort of have focused on. Do you have any recommendations for small businesses for software to use, or even maybe for individuals? Like, how can you keep track throughout the year so that you don't get to the end and your hair is on fire?
Well, I use QuickBooks, and I highly recommend QuickBooks because it also integrates with my ProTax Connect tax software.
Okay.
So I could basically flow through your whole trial balance into my tax
Just
software.
move it right in.
Move it right in.
And
One, two, three.
The same typically happens for individuals using TurboTax or
Yep.
those kinds of products.
Yep.
So using a product is something you'd recommend.
Yes. Oh, yeah. Don't try to do it by hand on the tax forms.
Okay. Well, thank you, Robin. I appreciate the time today, and I appreciate everyone in the audience joining us today. Thanks again, and we'll see you next time on another edition of Financially Fit with Jason Haviland. Thanks.
Saving and investing can be confusing and overwhelming. We're here to break through the noise, misinformation, and confusion with easy-to-understand concepts and tools that you can put into practice right away. Whether you're a novice investor or an old pro, join Jason as he explores different topics on investing and personal finance. From 401ks to better budgeting decisions, we'll cover it all. Our investment guidance will give you the comfort and security of knowing that you're on track to achieve your goals. It's time to rise above all of the distractions of daily life and take control of your financial future. Welcome to Financially Fit with your host, Jason Haviland.
The preceding program was provided by an independent producer solely responsible for its content. The opinions expressed do not necessarily represent the views of this station, its staff, board of directors, or underwriters.